there will be pain in the markets, there will be blood in the streets, and then the Fed will step in and have absolutely no choice but to flip on the money printer and absolutely flood the market with capital to ensure that it doesn't collapse. Because we have such a massive amount of debt at the Treasury that if the markets collapse, so does the Treasury. You can't have the markets completely collapse. They can go down 10, 20, 30%, but they cannot collapse. And they have to stay liquid. The Treasury market must stay liquid, and that's what it all comes down to.
For the 4th of July, Blockware is celebrating freedom by giving away a free Bitcoin mining rig. Sign up for the Blockware Marketplace before July 4th to enter for a chance to win a free S19 Pro. This machine is online right now at Blockware's site in Eastern Kentucky, and it is ready to have the hash power directed to you in minutes. Now, this model is currently trading for roughly $1,600 on the Blockware Marketplace. Should you win the giveaway, you can list your machine for sale at any price you choose. Or you can let it hash and receive Bitcoin mining rewards every single day. This is a limited time giveaway, so sign up now and complete the onboarding process at marketplace.blockwaresolutions.com. Hey everybody, welcome back to the Blockware Intelligence Podcast. This week I have on James Lavish. James, welcome.
Thank you for having me, Joe. I'm happy to be here. Always good to talk to you.
Yeah, absolutely. Let's jump right into it. We saw, BlackRock, their Bitcoin ETF or their Bitcoin trust, they're, scheduled or they're supposed to be filing that. What are your thoughts on that generally?
Yeah, immediately. As soon as I saw that, there was a lot of buzz on Twitter and in our circles, and some back and forth about whether it's good or bad. BlackRock, the big bad behemoth of institution coming into the space. But in general, Joe, I think it's a huge positive, and there are a number of reasons for that. Number one, structurally it is a trust, but functionally it acts like a ETF. So even though, and I have not dug into it deeply enough to know exactly what the nuances are. However, from what I can tell and what I've read through, it looks like it acts like an ETF in that the difference is it doesn't continuously update the underlying value of what it is supposedly presenting and offering investors on the exchange. So let's back up for your listeners. An ETF is an exchange traded fund. And what it does is it mimics whatever it's trying to show. So for instance, if you want to buy a share of the S&P, well, you can't really do that. The S&P 500 has 500 stocks in it. Unless you're doing fractional shares and you're calculating it out and you're buying a fraction share of everything with your $100, it's difficult to do that and keep it weighted properly. The weightings change, from the S&P. Stocks go in and out of the S&P 500, so it's difficult to do that. And so what you do is you buy the spiders, the SPYs. And so in doing that, you get a little bit of every single company, because what you buy the spider on the exchange that puts money into that exchange, and then at the end of the day, the ones who are running that ETF will reconcile the cash in and out and make sure that they have enough shares to show that underlying value of that ETF matches what it should for the ownership of those stocks, right? So, and it's a similar way with the Bitcoin ETF. The problem we've had up to now, Joe, is that we have a bunch of futures ETFs, and they're just paper settled, meaning that you're pretty much making a bet on the futures ETF or the futures Bitcoin price, and then it's cash settled when you buy and sell it, right? So there's no underlying asset that is attached to that paper, that future. Where with this, even though it's not an ETF, it's a trust, it'll act like an ETF in that the BlackRock will buy and sell shares or coins, Bitcoins, in order to match that in baskets at the end of every single day. So functionally, it will be like an ETF. And so, yeah, people will be able to borrow it, I imagine, and sell it short, just like you can with the QQQs or the spiders. But net, it's not like paper where you can sit on top of it and just create as much paper as you want in the futures ETF and never have to actually deal with the underlying. So, but what's most important about this is getting to be a long answer for this first question. What's most important about it, though, is that it validates Bitcoin as an independent asset allocation for institutions. It gives them an easy on ramp, right? So this is going to be like a highway, for a super highway for the institutions and small institutions that don't have the capability or the wherewithal, or they don't want to take the risk of keeping custody of those coins themselves. They will trust BlackRock to do it for them. And so what's important about that is that it gets over this risk hurdle for them. So if you think about registered investment advisors who have hundreds of clients, some of them thousands, then they don't want to have to deal with the custody of all those coins and getting over the hurdle of explaining to each of their investors what they're doing. This just becomes a verified and validated asset class that they can put their investors in now. And it makes it very easy. So the on-ramp of billions and billions of dollars, hundreds of billions of dollars, can come into this space through BlackRock through that alone. And that's and it's an important development. And then separately, whether or not it gets approved is a different question. I personally think that BlackRock is not going to go do this just offhand. They're going to have made their checks, determined what the most likely structure would be to get approved by the SEC. Probably had initial conversations with them to understand what their reservations were from prior ETFs that have been denied approval for spot ETF. And now I think that with BlackRock's record, I think they've filed for 575 ETFs and have gotten approved on 574 of them. I think it's a pretty high likelihood that this does eventually get approved by the SEC, and it'd be a big deal. I think it's going to bring a lot of capital into the space, into Bitcoin.
Yeah, I agree. I mean, it definitely seems like the odds are higher than it's ever been before for a product like this. Can you also maybe compare it to GBTC? I feel like a lot of people don't fully understand like how this product works compared to maybe GBTC, like the basics. I've had
Yeah,
people ask me like, wait, why did GBTC go down today when Bitcoin went up, And like,
yeah.
can you explain that to people?
Yeah, the problem with GBTC has always been that it's got a trust structure, but it was created in tranches, and so these shares of GBTC were issued, and the underlying investors are locked up in them, so they can sell in the market, but they're selling at a discount to what the actual price of Bitcoin is because whoever buys that is locked up. And you can't turn that in for a share of Bitcoin, or the satoshis, that the amount that you would have bought through that trust. The difference here is they're settling that trust on exchange every night with baskets, and so you're not locked up in the same way. So it shouldn't have. It will, Joe, have some discrepancies, and there will be some arbitrage that people will play throughout the day, but it won't be like this 20, 30, 40% discount to the price. It might be a few percent on major, very volatile moves, but those will be short-lived and they'll close up quickly. So that's how I would see it and what I would expect. Yeah.
Yeah, it definitely seems like this would be a much better product than GBTC. And GBTC, I think at its peak was like a $50 billion trust. I mean, or at least that's what it was trading at. So maybe
Yeah.
this could be, like you said, like $100 billion. We'll see.
I would expect it. I would expect nothing less, to be truthful. This is going to be a big deal in my mind. And then with Fidelity and Schwab, and getting together and this creating exchange And I mean, this is also a very big deal. Another point of validation and an entry point for people to understand. It gives it, with all of the negativity around FTX and Coinbase, this will give people much more comfort. People who are out there that I talk to every day. I was just on a camping trip with a bunch of U.S. Military vets, and this last weekend, and some of them really they understood. There were a few that really understood what was going on, but a few of them they were perplexed by all of the misinformation that's out there and the conflicting information, and so their first question was, well, even if I want to buy it, where can I buy it? Because none of these exchanges are trustworthy. So if you have an exchange that's built by Schwab and or Fidelity or whatever it ends up being, that will give instant validation to this, and so it's a really big deal. And that could be, I was just talking to Greg Foss just a few minutes ago, and he thinks it could be even bigger deal than a straight ETF, and he might be right. I mean, this is a really big deal. But Bitcoin price is up quite a bit, and it's because of this. Let's make no mistake about it. It's not because people are expecting the Fed to pivot today, or, I mean, clearly with the Fed futures are pricing in a 70% or more likelihood of a rate increase this next month. So that's not it. It's this. And if we weren't in such an uncertain environment economically right now, I think Bitcoin would be up way more, and it's just this is something that I think is a huge positive in the development for Bitcoin adoption by across the board by people and understanding it.
Yeah, I want to start diving into like some more of your macro thoughts, but real quick, it seems like regulators and like I guess Wall Street generally have kind of like pushed away from crypto, and they're like starting to like really embrace Bitcoin. Like it seems like, the SEC attacking Coinbase and Binance kind of around the same time, and then all of a sudden like BlackRock, Fidelity, and all these companies are trying to get into Bitcoin. Like it seems a little weird. Do you think that's a trend that's like taking place, or do you think it's just coincidence that this is all happening at once?
I mean, let's face it. I think they've been doing. Look, these companies don't do anything quickly, right? They're behemoths, and there's a ton of red tape. I've talked about this from the day I got into the space years ago about how the problem with entering the space is that there's so much red tape, right? I mean, just to get approvals if you're a portfolio manager and you want to buy Bitcoin and you're at a place like BlackRock or Fidelity, or you're at State Street or CalPERS, like these huge pension funds, or these huge money managers, you have to go through multiple levels of approvals to get there. As a portfolio manager, you have an analyst that briefs you on it. Then you dig in, you get through it, you do your research, you do your, 100 hours of research, and you get through it to the point where you feel comfortable with buying it. Well, then you've got to get the buy-in from your chief investment officer. And then once you get them to approve and them to agree that, yeah, this can be an asset allocation in your portfolio, well, there are some nuances to Bitcoin that you have to get over, which are like, how do you custody it? Who's going to trade it? Where are you settling it? What exchange are you doing it on? And these are things that legally you have to get through. Are you holding them yourself in cold storage? Are you, do you have a custody solution? Can you use your own prime broker? Do you have to get a different prime broker? And then you have to go through all of those operational details and get approval from your general counsel. And the general counsel will tell you whether or not, legally it's too big of a risk for the firm to. There's just so many hoops together, and that takes months and months. It doesn't take weeks. So imagine if you want to do something like you're BlackRock and you want to create an ETF. That's not a portfolio manager coming in, or some sort of asset allocator coming in and saying, hey, I think we should do this. We should create this product. A product manager saying we should create this product, and it gets approved that week. That takes a long time. So think about how long they've been looking at this. Well, then you think about all of the damage that has been done in this space over this past year between FTX and Celsius and all of the problems we've seen and the nefarious activity, the fraud, well, that's given them pause and made them step back. Now the regulators are swooping in, and that gives them a little bit of surety. Bitcoin's been held out from this pretty much completely on the regulator front. And so now they're saying, okay, this is an opportunity, and now we should push forward. And they've all had their kind of their ducks lined up, and now they're all coming forward because we're getting some clarity. We're going to get regulation around this. It's clear the regulators are going after certain protocols, but not Bitcoin. And so I think it gives them quite a bit of certainty, and they feel like the risk has been mitigated to the point where now they should take advantage of this opportunity now. So
Yeah, it's a pretty awesome time to be in the Bitcoin space, and hopefully we'll continue to see like interesting developments like that. I do want to dive into macro because I know you're an awesome macro thinker. We had the banking crisis earlier this year with Silicon Valley Bank and a few others. Do you think that's over now, or will we see a resurgence of the banking crisis?
yeah, no, I don't think it's over. In fact, you heard Powell say it today that there's some there even though the banks are well capitalized in both Powell and Yellen's statements, the problem is that there's still some issues on the horizon that have to do with interest rate risk and with what that has done to the various markets and the kind of specific risks that creates for banks and especially for regional banks. And I just wrote a thread about this today. There's a problem in the commercial real estate market, and the issue is that we had this. You remember back in 2020, obviously the work from home thing took off. Nobody worked from home before that, right? There was a great migration to the cities. And so there were all these reports about how, cities were actually, they lowered people's carbon footprint because you're in smaller spaces, you're moving shorter distances. And so it's like everybody's moving into the cities and into the urban areas. And these, the commercial real estate just had a massive boom after 2008. And so then you have this lockdown, right? And so people are at home. They set their whole, they have a whole setup. Now I had a setup because I'm an investor and I want to be able to always see the market, wake up in the morning, see what's going on. Where that wasn't typical for your average person. They would check their email and they would start doing their work when they got to the office. But then they had to set up a whole office at home. Well, it got to be easy to say, well, I can work from home. It obviously worked fine. For a lot of industries, it was very easy for people to say, well, we'll cut back our staff. We've had these conversations. It's clear that 100% workforce in the office is kind of dead. That's not going to, that ship has sailed. So now you have these offices, especially in the urban centers that have a lot of traffic and it's difficult to get to. Their occupancy is way down. Right. So, and so the issue is for everybody to really understand, what does that really mean? Okay. So the occupancy is down. Well, that means that the businesses are not re-signing leases, or they're signing leases for smaller footprints. They don't need quite as much space because they don't have as many people in the office, which means that the landlord that owns the building is generating less revenue. Okay. At the same time as rates have been going straight up, right? So Powell, he jacked up rates by over 5% in less than a year. So now what happens to real estate prices when the cost of capital goes up? Well, real estate prices have to come down, in order to offset that, especially if you have a situation where the revenues from those office buildings is lower, right? So the cap rates are out of alignment. So now you've got the occupancy rates are down, landlords are making less money. And so at the same time, rates are up, and you've got a whole bunch of these leases that are on variable interest rates, right? Or they're coming due, or I'm sorry, not the leases, the mortgages on these properties that they're either variable and they've been going up, or they're maturing, and so they have to be refinanced in the next. There's like over $2.5 trillion of commercial real estate has to be refinanced in this next. I want to say it's 42 months, I think is what I saw. And so, the problem is that there's almost $2.6 trillion of commercial real estate loans that are coming due. Well, here's the problem, and it gets to your question, Joe, is that $1.4 trillion of that is with banks. And most of those are with regional banks. And so what's happening is, and we're seeing it, $3 trillion $3 billion of real estate was walked away from the last couple of weeks. What happens is the landlords are just handing in their keys. They're non-recourse loans. So they hand in their keys, they walk away, they take a small loss, and they're like, okay, I'm not going to take any more of a loss on this building. Now it gets put on the bank sheet. Now the banks have this asset that's now impaired, that's sitting on their sheet, and they're not making revenue off of that loan. The loan is defaulted. So what happens? Well, it's stuck in the bank's balance sheet, and they've got to turn around and sell it or do something with it. And so it's a major issue that is going to creep up. It's right ahead of us. Do I think it's going to happen next month? No, but I think we're going to see more and more of these leases walked away from, mortgages just defaulting because of the landlords and owners just walking away from them. Non-recourse, like I said, there's no legal recourse for the banks to come after them, and so the banks are stuck with the bill. They're holding the bag, and it's going to cause problems.
Yeah, it's quite fascinating. I mean, I would definitely not want to be holding a commercial real estate building right now. That would be a little stressful.
Well, and here's the funny thing is that some buildings are doing better than others, right, Joe? So, if you look at the office space is down, the change in property value because of what we're talking about, because of the higher interest rates, because of the occupancy rates down, the change in value of office real estate is down about 5 or 6%, right? So in the last year, and that's not going into this year. These are figures from last year. And I think Trepp put it at about $500 million worth of $500 billion worth of impairment that's on the horizon for these, right? So on the other side, though, industrial and hotels are doing pretty well. They're up 5 to 10% and maybe more. And so it really depends. It's specific to what you own, which is why I'm saying that this commercial real estate thing, it's not going to be like the housing crisis. It's not all the way across the board. It's not going to take down commercial real estate everywhere. But the problem is that the holdings of these office buildings are concentrated in regional banks. And that's the issue. And so at some point, we're going to see a regional bank pop up with a major problem because a landlord walked away and just handed in the keys. And that's where I'm concerned. And then your concern is, well, does the Fed protect them? Does the Treasury come in and help like they did in Silicon Valley, or they let them die? And if they let them die, is there going to be contagion from that? Is that going to pull a string where other banks are going to get hurt from it? That's a tough question, and that's the one I'm watching for.
Yeah. Do you have any insight on like which way that might go? I mean, I feel like the precedent for Silicon Valley Bank might be to bail them out, but if it's such a small bank, maybe they will just let it go down.
I would say that there's no way that the Fed will allow contagion if they see it. If they see that there's a risk of systemic risk, they will come in. He said it numerous times. We watch for systemic risk. We're watching for that. We don't see systemic risk. We're watching for that. And if they see it, of course they're going to come in. They're going to come up with some sort of new vehicle that they're going to come up with some way to shore up the bank's balance sheets or give them some sort of lifeline to enable them to survive and to ensure that it doesn't take down more banks.
Yeah, makes sense.
And we've all seen that meme of the one domino with the big dominoes stacked up. That one domino can topple the big one at the end. And the big one at the end is the Treasury, and they all know it. So they've got to be careful.
Yeah, I like it. I know you kind of did write an interesting Twitter thread relating to the debt ceiling being resolved a little ways back, and then how the Treasury will need to refill its accounts, which could break markets. Can you kind of explain like what's going on there with the Treasury? Hey everyone, this week I want to talk about Stampseed. This is very cool metal plate where you can literally stamp your Bitcoin seed phrase with this hammer that they sell you into this metal plate. This is a must have for all Bitcoin holders. If you have taken self custody of your Bitcoin, you want to make sure you've recorded your seed phrase on something that is fireproof, waterproof, and time resistant. This is a great product for Bitcoiners who have taken self custody and want that extra level of security and resiliency to store their Bitcoin. So if you are interested in this product, definitely check out stampseed.com. Use code Blockware15 for 15% off the entire website. This expires at the end of May, so go to stampseed.com today.
Yeah. So, I mean, the Treasury General Account, the TGA, is like the checking account for the U.S. Treasury, right? And so we actually tripped the debt ceiling back in January. Okay. And so when we did that, you heard Yellen come out and say, we're going to use some extraordinary measures in order to ensure that the Treasury doesn't default. Okay. So what do I mean by that? Well, the problem is simply the U.S. government, the Treasury, operates in a deficit. It's not the Treasury's fault. It's Congress's fault. Okay. So we spend more than we take in. Well, if you think about a business, right, and I've written a lot about the debt spiral of the United States, and there are many other countries that are in the same position. And the problem is we operate in a perpetual deficit, and the issue there is that the United States does not generate enough productivity and tax that productivity to pay for all the programs that it spends money on. And in reality, you and I are producing. Like we're producing right now. This is going to generate income for whoever you are putting this up for, whether it's YouTube or anywhere else you put these podcasts up, Twitter, this will generate revenue for them. We're doing that. And then they'll get taxed on that revenue. And then that tax pays for the expenses, right? So that's all they do. They tax and spend and spend and spend and spend. So, okay. So what that means is that since we operate a perpetual deficit, every single year we have a shortfall. And so we have to issue treasuries. We have to borrow money from the people of the world in order to make up that shortfall, to have enough money to pay for all those programs and to pay for the treasuries that are maturing, right? Because when a treasury matures, when a U.S. treasury matures, well, we don't have enough money to pay for that from our GDP, from our tax base, right? So what do? We issue more treasuries. Okay, so when you hit up that debt ceiling, now, we can't issue any more treasuries. What do? Well, the first thing that we did was we borrowed. You've heard the expression, steal from Peter to pay Paul. And so that's basically what the Treasury was doing, using internal programs where they weren't paying for retirement funds of postal workers and military vets, and they were using that money for other programs that they had to pay. They couldn't just hold them off. And so they were able to limp along until the beginning of this month, where we were right up against that ceiling. We depleted the checking account, and the TGA was down to like 20-something billion dollars, which would be like you having $50 in your bank account and you owe $31,700 on credit card bills. That's kind of what that's the way the math works out. Okay, so it's a problem, right? You would have like $20 in your bank account. So now the Treasury they're rescued by Congress. They say, okay, we're gonna cap the spending, but there will be no debt limit, right? So, okay, the Treasury can go out and start issuing debt again. Well, that's great. But remember, The Treasury usually, TGA usually has about 500 to 600 billion dollars in it. Now it's got 20 billion or 30 billion, or a number of weeks ago it did. They're starting to fill it back up. Okay, you've got a few things. You stole from Peter to pay Paul. You've got to pay that money back, right? The programs that you put on hold. You've got to refill the Treasury account. So you're talking about $500-600 billion right there, right? And then you've got all of these treasuries that are maturing this year, right? So you've got the treasuries that are maturing not just this year, this month. You've got like 225 or 250 billion dollars of treasuries that are maturing this month. You've got to issue more treasuries to pay for those because you don't have money in your account to pay for those. So you've got to borrow to pay off, right? And so now you're looking at over $1 trillion that you've got to issue in debt in like 4 to 6 weeks. So that's a lot. So what is that doing? Well, there's some challenges for the Treasury. One of the challenges is we've seen that our major buyers of treasuries internationally, especially the sovereigns, have backed off. China and Japan have backed off quite a bit. They're not buying treasuries like they were before. And you can see it on the marginal buyers. There's a chart that I had in that post that showed just how little some of these countries are buying now, right? So that's number one. Then number two, so what do you have to issue $1 trillion worth of debt? Well, so who else is going to buy it? Well, we've talked about the reverse repo market. There's this cash hoard that's in this reverse repo market. What is that? Well, after 2020, when all this money was printed and all these, with the Cantillon effect, these banks are sitting on, the big banks are sitting on trillions of dollars. There's over $2 trillion that they don't really know what to do with. They can't buy U.S. treasuries with them because they're capped out on leverage limits, right? So they can't buy treasuries with them. And you've got money market accounts they have to keep up with. So they put it in these vehicles that are offered by the Fed. It's called the reverse repo vehicle. And so you've got over $2 trillion just sitting there, right? And it's making pretty good interest. Okay, so you've got that they can tap into. But remember, I just said, the banks have a limit to the number of treasuries they can own, right? The ratio on their balance sheet that they can own. So in order to do that, the Treasury would have to be issuing shorter term debt, right? They'd have to be issuing T-bills, something that's not a 30-year bond. They would have to be issuing much shorter paper in order to pull money out of that reverse repo market. We've seen them do it. They've been doing it the last few weeks, and that's a good game plan because it's not tightening, right? Because that money's just kind of sitting idle already. It's just sitting there. So they're not really taking it out from reserves that these banks are using to shore up their balance sheet. That's just reverse repo money. It's just sitting there. It's excess cash. So that's one thing they can do. And that's a pretty good playbook, right? But you're talking about the Treasury okay, so you've got $1 trillion they need. That would be half of the reverse repo money. So they're not going to take all of it out of there. Where else can they dip into? Well, the banks have like $3.3 trillion worth of reserves, right? That they've got on their books. All right, so if they were pulling money from reserves, then again, that would be tightening because those reserves would then not be available for liquidity in the markets, right? So that would be pulling capital out of those reserves and basically parking it at the Treasury, right? So, but to do that, again, they've got the liquidity coverage ratios that they have to deal with, right? And so there's a question there. There's only so much that can go into that. And then on top of it, the Treasury's been talking about the fact that they've got they're trying to sell some of those $5 trillion worth of bonds and the commercial paper, the CMB paper that they had bought. So the mortgage-backed securities. So they're trying to sell $95 billion of those every month. So that's another, they need more liquidity there. So I don't know where it comes from, Joe, but they're treading lightly. It looked like bond auctions are doing okay still. There is enough capital out there to be soaking it up right now. I don't see an issue yet, but it's a lot of capital, and it's only going to get worse because, as we've seen, tax receipts are going down. We are headlong heading into a recession, and Powell has all but admitted that's where he wants us to be because he needs to get inflation down. So when we have a recession, tax receipts are going to go even lower. The deficit's going to grow, and it's going to get even worse. Because on top of that $1 trillion we're talking about today, there's another over $1 trillion that the Fed needs, that the Treasury needs to raise in the next 6 months because of the deficits. And that's a minimum, right? We're already running over $1 trillion deficit run rate in the first half of 2023. And it appears to be getting worse on the back end. So how much do they need? 1.5 trillion, 1.2 trillion. It's a lot of treasuries. And the issue that really points to is that the Treasury is beginning to crowd out marginal balance sheets, right? So, you've got these balance sheets that are on public companies who are making less money now, who don't have the same amount of cash, or they're starting to dip into cash for, expenses that they were using for just savings before in their treasury. And so now the the Treasury needs more money. And so some of those balance sheets are being crowded out by both the tightening in the economy, the tightening of their margins and their profits, and just the sheer load of debt that's being issued into the market. And I don't know who buys it all. We'll see.
Yeah, that's really fascinating.
Like Luke Groman says, let's watch.
Yeah, that's fair. Because I feel like also throughout all of 2022, like it was such a tough time that it makes sense for a lot of people to like be taking, like going risk off, like buying cash, buying T-bills. And then it's like if the flip switches and like all of a sudden we're off to the races and everything's running again and they're trying to issue a bunch of T-bills, it's like, then who would really be buying? And
Right.
I don't know.
Yeah, and really, what I'm more worried about, Joe, is I do believe we're going to hit a recession here. I do. I just believe we're going to do it. We're going to hit a recession. The Fed's going to hold rates longer than higher for longer than they should. They will make a policy error. If they raise them again in July, I think that's a policy error. We'll see. We'll see what the data looks like. But remember, they're looking in the rearview mirror as they're driving headlong toward a cliff, right? So that's the issue here. And so all of these tightening measures that they have, raising rates, QT, selling bonds into the market, selling $1 trillion of treasuries, that's all tightening. You've seen the lending practices tighten up on banks. So there's just less liquidity out there. There's less access to capital. The capital costs more. This all points toward we're going to go into a recession. And so when that happens, the question is, do we have some sort of credit event before that? And that's what concerns me about all of this tightening that is going to occur with the additional treasuries that the Treasury has to issue, and with the tightening around the markets. And so, like we're talking about with the commercial real estate, does that trigger some sort of credit event, and where a bank fails? And if that bank fails, the counterparty risk of another bank fails, right? That counterparty fails, which is counterparty risk, causes this bank to fail, which may even be bigger, and then this bank fails, and that's contagion. That's the danger, is that we hit some spot here where we have some sort of credit event where you have, some sort of trigger that sets off a chain of events that causes what we're talking about as systemic risk. And so, and if that happens, well, there will be pain in the markets, there will be blood in the streets, and then the Fed will step in and have absolutely no choice but to flip on the money printer and absolutely flood the market with capital to ensure that it doesn't collapse. Because we have such a massive amount of debt at the Treasury that if the markets collapse, so does the Treasury. You can't have the markets completely collapse. They can go down 10, 20, 30%, but they cannot collapse. And
Yeah,
they have to stay liquid. The Treasury market must stay liquid. And that's what it all comes down to.
crazy. I guess how should investors or individuals like position themselves like going into this? And like, could you argue that like, the Silicon Bank crisis was that kind of, I guess the Fed didn't completely rush in with all the liquidity quite yet. So it could be in the future, but if it does happen in the future and we do have some sort of like initial phase of a credit collapse, how should investors be positioning themselves?
Well, that's a good question. And I get that a lot. The first question, Silicon Valley, yeah, that absolutely could have triggered a number of other. It could have triggered some counterparty failures, and remember who the investors were in that bank, who the depositors were in that bank. They're these startups to huge tech companies, a lot of tech companies, right? So, if I remember correctly, Roku had $300 million deposited there. I mean, it wouldn't have impaired them, but that would have been painful for that company. Okay. So, and then you've got a lot of private equity and venture capital firms that had a ton of capital tied up there and deposited at that bank. So there could have been a major triggering event. So, the second question, how do you position yourself? First, I have to say everybody's different. Okay. You're different age, different income, different liquidity, different liquidity needs, and then different appetite for risk and an ability to handle the risk, right? So everybody is different, but I can tell you what I've been doing, if that helps. I'm a little bit older than you by about 3 or 30 years. And so, I'm not. I'm a little bit more cautious than somebody who's in their 20s. Even then, what I've been doing is I've held a large percentage of my personal account is held in cash, short-term treasuries that have high interest rate that are just rolling off, and because I don't believe that the Fed is going to, or the Treasury is going to hard default. I talked about a lot on some of my newsletters, and I feel like that's not a danger near term, long term maybe, but not near term. So that's first. I've also been buying things like gold, silver, and Bitcoin opportunistically as they've come in. And so Bitcoin's been running because of what we talked about earlier today. But when that does take legs down, I've been buying opportunistically. Why? Not because I believe that they're going to do well if and when the market has a downturn. I think that they'll all get hit, but I think they'll do extremely well in the event that the Fed does pivot and turn on the QE again, which I think they're going to eventually be forced to do. And so with the expansion of the money supply, those assets, the hard monies, will do very well. I think that, you'll see that they'll have a beta, like gold will do very well. Silver should do even better, and Bitcoin will do way better than both of those. That's my feeling, and that's what I believe. That I have strong conviction in that. But importantly, the cash that I do hold is fully FDIC insured with a GSIB or similar, and so I'm confident there. And yeah, I'm just watching for opportunity, and as it comes in, you can't time anything perfectly. I've been doing this way too long to know that you just can't time it perfectly. So you just buy it as it comes in, and when there's blood on the streets, you're supposed to be buying it, even if it's your own blood. That's what it is. So
Yeah, I like it. Yeah, I like kind of like a barbell strategy of like T-bills and Bitcoin. That's kind of what I've been doing. A lot more Bitcoin than T-bills, but I feel
you're a
like
little bit
that's
younger than me. That's okay,
yeah,
But I have a significant allocation to it myself. So you
I
know,
like it.
yeah.
Awesome. One last question, then we can probably wrap it up. So I guess like timing wise on like when we might see a Fed pivot. I know, like you said, timing is really impossible. But if you had to guess, when might that be? I mean, is it going to be 6 months from now? Is it going to be 2 years from now? Is it going to be 5 years from now?
Yeah.
When do you think it could be?
Yeah, it's a good question. I think, well, first of all, I do believe that the market is overestimating the likelihood of a rate raise in July. Now, that said, the Fed has demonstrated the ability to get things extraordinarily wrong. So, and they've made some massive policy errors in the past, including allowing this expansion of the money supply to get so out of control in 2020. So that's number one. So I would put it more at 50-50 or less in my opinion. But let's see what the numbers come out, because what the Fed is going to need is firepower. They're going to need air cover from the CPI and PCE numbers. They're going to need that in order to justify saying that we're above the neutral rate, meaning that if you're at the neutral rate, it's not tightening, it's not loosening, it's kind of like it's Goldilocks and the three bears, not too warm, not too cold, it's just right. Like that means that it does not add to expansion of the economy, and it's not tightening it, right? So that's number one. I believe that they need some air cover, and if they get it, they're just going to hold it there and say, look, we're above the neutral rate. We're seeing tightening. The numbers are coming down. We're going to be patient. We're going to see what happens for the next meeting. And they're going to hold the market off from jumping the gun and saying, oh, they pivoted, right? But then you have the issues that we're talking about with commercial real estate. You're talking about the cost of capital has gone up multiples of what it was just a year and a half ago. Okay, so companies are starting to feel that pinch, which means that their margins are coming in, which means that their profits are coming in, which means that the multiples that they're trading at are going up in the market for the same amount of earnings that they're getting, right? So because their earnings are going down, that means multiples will have to come down, and then all feeds on itself, and eventually, like I've showed a chart, I think I showed it again today, is look, don't every time I hear somebody say, oh, unemployment is very low, we're still not in a recession. Unemployment does not really spike until we're already in a recession. So that is not a good indicator. And I do believe the Fed is using that as coverage to keep raising rates and saying, oh, no, it's okay, it's okay, it's okay. We're still at full unemployment because it's one of their mandates, but we're going to turn around and that unemployment's going to hit fast. Now, all that said, Joe, this has been the most difficult investing environment I've seen in my career, right? And so you've got a lot of different factors going on here. You've got the expectation of the Fed pivoting with all that money supply coming in. You've got the danger of this massive debt spiral that the U.S. has already entered. We're at the beginning of it, but we've entered it. All the leverage in the system. You've got the commercial real estate issue, but then the other side, you've got this introduction of AI and how incredibly efficient it can make everything, and a lot of things. And so that could add to the bottom line of companies because you'll have the ability to generate output and productivity that you didn't have before with the same workforce or less. So it's a really weird dynamic, right? So companies may be more profitable, but workers could be laid off. So how is that going to work, right? So it's a really interesting thing. So, but all that said, I still believe that we're going to see a downturn in the economy. To answer your question directly, I do think we're going to see a downturn in the economy by the fourth quarter this year, first quarter next year. It's just, and I wouldn't be surprised if we had some sort of credit event before that. So I'm
Wow.
watching.
Yeah, I think that's very fair. This was an awesome conversation. I really enjoyed listening to a lot of your thoughts here. James, do you have any final thoughts and a place to maybe send the audience to as well?
Yeah, no. So a few things for some of the people listening. First of all, they know that I have this newsletter. It's called the Informationist, and all the things that we talked about today, I've explained in great detail in this newsletter that I started last year. And it takes all these concepts and it makes it super simple for people to understand. Comes out every week. There's a free version of it that I give a lot of newsletters that are free out there that are talking about all this stuff. So I encourage anybody who's interested in it. It's gotten great feedback, and go check it out. It's free. And then for some other of your listeners, they may know that I started a hedge fund with some of the people you've had on the show before. It's called the Bitcoin Opportunity Fund. It is for accredited investors. That's not my choice. It's a SEC law. It's taking advantage of some of the opportunities in the markets that we talked about, and watching for these and waiting for this to happen. It's a Bitcoin only ecosystem focused public and private fund. So if anybody's interested in that, you can check it out. It's bitcoinopportunity.fund, and my newsletter, you can just go to my profile on Twitter or just go to jameslavish.com. It's right there. But awesome talking to you, Joe. I really appreciate it. It's always fun, and I always want to catch up with you more at the conferences, but we're both running all over the place and we don't get a chance to just sit down. So I think next time we have to sit down and just have coffee or something.
Yes, let's do it. I'm down. Yeah, the conferences are fun. It's a lot of talking to people, but yeah, you're constantly busy and constantly running around. But
Yeah.
thanks again, James. This was awesome. Really enjoyed it.
Me too. See you next time.
Yeah.